All right. And we are live. Looks like we have a good crowd here. Welcome, everyone. Go ahead and drop in the chat box here. There's a live event. Go ahead and drop in just where you're coming from and who you're here to listen to and who you're here to see. So I'm going to go ahead and do some introductions here in a minute. Introduce myself. My name is Bronson Hill, and I'm the managing member at Bronson Equity. We do educational events like this every month. And we also are syndicators. We have about $100 million in multifamily real estate. We work with passive investors. That's what we do. Why this topic is really important. We're going to talk today. Super excited. Just the people that have agreed to come on this are just really. It's actually really humbling to me. They say don't be the smartest person in the room, and if you are, you need to find a new room. So I'm definitely not the smartest person in this room, but I'm very excited to be here. So this topic about inflation, we're going to get into it. We're going to talk about all the different things that are going on, all the different reasons, the Fed printing trillions of dollars, all kinds of stimulus. What is the best place that you should be positioning yourself, positioning your assets so that you can not only preserve your wealth, but that you can grow your wealth and really take advantage of this time, because there are going to be people that really position themselves correctly and just exponentially grow their wealth. So that's what we're going to talk about. We're going to jump into it here in just a minute. I'm going to talk through kind of the flow of this, and then I'm going to introduce each of our panelists here. So basically, we're going to intro the speakers. We're going to spend some time doing just panel discussion with some specific questions that come up. And then we're going to actually do some Q&A. So just get ready on that chat box. You can ask questions now. We will not get to them till the end. So just kind of hold those questions. And then we're going to kind of jump into it. And then we're going to talk about how you can reach out and follow each of these awesome guys. So I'm going to jump in and do some bios here. So with us, we have George Gammon. George Gammon is a real estate investor, entrepreneur, and teacher of macroeconomics on YouTube. He has over 300 subscribers on YouTube. And prior to 2012, he started and operated multiple businesses in the convention and advertising space, grew his last business to $24 million in annual revenues and over 100 employees. So welcome, George. How are you doing today?
I'm well. May I make a small correction?
Sure.
3 zeros.
300,000.
Did I say 300?
Yeah.
300,000. Okay. I'm a little nervous here being the president of you guys. Yeah, 300,000, 300K. So
it's a lot.
Definitely has more than 300. That's why I made a note of it. So thank you for that correction. And just a little side note, George and Russell and I were at the Real Estate Guys Summit in Belize, which was an amazing event with just some amazing people. We got some time. I think George and I were snorkeling together. It was a lot of fun. So had a great time there. Also joining us is Jason Hartman. He has been involved in several thousand real estate transactions, has owned income properties in 11 states and 17 cities. His company helped people achieve the American dream, financial freedom, by purchasing income property in prudent markets nationwide. He has the complete solution for real estate investors. He also has an awesome podcast, and he's the author of Become the Brand of Choice. So welcome, Jason. How are you today?
Thanks, Bronson. And I should mention that's a really old book. My new book is coming out, and it's called The Empowered Investor. So very excited about that and excited to be here.
Oh, it sounds like a great book. Can't wait to read it, man. That's awesome. Good to have you. Also, we have Russell Gray, who is the co-host of the Real Estate Guys radio and TV show. He's been a financial strategist since 1986. He's a faculty member of the California, I don't know if you still are, Association of Realtors. I probably have an old bio here, but he's one of the smartest guys that I know. He co-wrote a book called Equity Happens, Building Lifelong Wealth with Real Estate. So welcome, Russell. How are you today?
Great. Happy to be here and excited to talk about this topic with these two guys. Been following Jason. Jason's probably been podcasting longer than Robert and I have. He goes way, way back. We get credit for being the oldest guys in the room, but that's just because Jason looks so good. But he's actually been doing it longer than us.
That's awesome.
When did you start your podcast, by the way? I thought we started around the same time.
Yeah. So I didn't even know what a podcast was. We were doing conventional radio and we were on 13 stations nationwide, and we were kind of expanding that syndication. And the producer came to us and said, "Hey, you guys ought to take a look at podcasting." And I said, "I don't even know what that is." And so we were actually podcasting before I even knew what a podcast was. But I took over kind of running it in the wake of 2008. We couldn't afford to pay the producer anymore. So I've been actively involved in it since about summer of 2009. And when I started watching it, you were already there. And I could see what you were doing, and there were some other folks, but people come and go, but you've stood the test of time, and so have we.
Yeah. Yeah. Don't feel like you missed too much, Russell, because back when I started podcasting in 2005 or 6, nobody else knew what a podcast was either. So
yeah. That's probably about when we started. We started before the crash. I just, I wasn't paying any attention. We had other things we were doing. We didn't get serious about the Real Estate Guys as a brand and a show until 2009, after we shut down the mortgage company, the brokerage company, and kind of retooled everything we were doing in the wake of the GFC.
Yep.
Well, on that note, let's jump into it, guys. Let's really get into it. I know a lot of people are really eager to hear about inflation, and not just hear about inflation, but hear what you should do. And just a little disclaimer here, we are not telling you personally what you should do. This is all just our opinions. It's all educational. But let's start with Russell. Like, why are most people unprepared for inflation, and why is it important to talk about and learn about?
Well, I think the first reason most people are unprepared for inflation is because they don't even know what it is. Some people think inflation is rising prices. And so I'm glad you tossed it to me first, because I do feel like if you're going to have a conversation about something, you kind of have to set a baseline. So I'm going to kind of throw out when I look at the numbers and, that nominal thing, looking at things by the numbers. And I learned this term from Nomi Prinz, nominal confusion. And I think that's something people have to understand right now, because you can have big numbers, but recession, that's called stagflation. And I think that we probably are going to see that. And it's extremely confusing. Prices going up, but purchasing power going down. Prices going up, but prosperity, personal prosperity going down. And so how you navigate that is unique. But if you just look at what causes prices to go up and down, I think there's 3 major components that all get put in a blender, and it makes it hard to discern. One is the quantity of money. More dollars chasing less goods, that's inflation. Less dollars chasing more goods, that's deflation. So inflation and deflation is a relationship between the amount of money versus the amount of goods and services. Inside of that, but off to the side, is supply and demand. It has nothing to do with the quantity of money. It has to do with what people want. And so the old thing in economics is supply and demand. But I think supply and demand, and I break out from demand, capacity to pay, because there's another third component. And so if you have supply and demand, you have the number of people bidding for something versus them wanting it. And if they want to bid more for something when you're not expanding the money supply or adding debt, then they have to pay less for something else. And there's kind of an equilibrium, if that makes sense. But the third component is leverage. And when you bring future dollars into the present, so that you bid up, it's why when they make financing for cars to make a car more affordable, it makes cars more expensive. They add financing to make college more affordable, it makes college more expensive. Why? Because they increase the purchasing power in the present by pulling the money in from the future. 2008 great financial crisis, we saw purchasing power go down, or leverage go down, because the lending collapsed, and real estate is very dependent upon lending. So the idea, when prices go up or down, there's 3 things at work. There's inflation or deflation. There is supply over demand or demand over supply. And then there's leverage, money coming in or not, depending on what's going on in the lending environment. And so I think you just have to kind of understand that. And then when you're looking at price movement, you got to discern what's the primary driver, because sometimes supply and demand, like shortages we're experiencing right now, can be mistaken for inflation or used as cover for inflation. And then you can get head faked. And that's this whole concept. Is it transitory? Is it permanent? Well, we're going to find out. But those are things you got to think about.
Right. Yeah. It really is a lot for a lot of people to think about, because they don't think about some of those supply and demand things, as well as, how many, goods and services, how much money's being printed, all of that stuff. So that kind of leads us to Jason. So talk to us a little bit about why the government can't be trusted to tell you what inflation is, or just maybe something about the CPI, or you can talk about a little bit more about inflation.
Sure. Well, George can probably dive into this one quite a bit deeper than I, but generally speaking, the CPI, the Consumer Price Index, the most widely used measure of inflation, the government has a very big incentive to manipulate this index and make it look lower in terms of lower inflation rates than they really are. And they do this in three major ways: weighting, substitution, and hedonic indexing. So weighting just means of this basket of goods in the consumer price index, they will weight things with different amounts, right? Like what percentage you spend on housing versus what percentage you spend on food, et cetera, et cetera. So that's weighting. Substitution will be something like this. If the price of beef goes up, they just assume everybody will switch to chicken, but maybe you don't like chicken. Maybe you think chicken's a dirty bird and you'd rather have beef, right? They assume the substitution, which may not really exist in the marketplace. And then hedonic indexing seems kind of logical on its face. And what that means is the word hedonism is pleasure seeking, right? So how much pleasure do we get out of an item? So for example, this phone, I get, I guess, a lot more pleasure out of it than I did from my first phone that was $3,200, 14 pounds. And, I actually literally financed the phone when I bought it, right? So they assume that we as people aren't entitled to progress because they index that in. They assume that the price is lower when it's really not lower just because technology has made it better. But I say, aren't we entitled to progress? What if you hedonically indexed everything from the electric light bulb or the wheel? I mean, everything would be free, right? But it's not free. We still have to pay for things, and we're entitled to the progress. So the government, all of the government entitlement programs are indexed to the CPI. The government's salaries, and the government is far too large a segment of the economy now as an employer. Those salaries are indexed to the CPI. So the government has a huge incentive to mislead the public on inflation. And then the last reason, of course, they do is they just want us to feel better about our lives and our standard of living. They're faking us so that they can stay in power.
Yeah, actually, it's interesting. Something that I hear a lot about is the site called Shadow Stats, that if you use the 1980 metrics, we're above 13% inflation right now. And if it's 1990 metrics, because again, it wasn't good enough in 1980, they had to change it again, and it's actually above 8%. But if people really believed that inflation was that high, and of course, we're seeing spikes in construction costs, sometimes 3-4 times, lumber and all these different things. They say, oh, it's temporary or it's transitory. So George Gammon, why don't you talk to us a little bit about transitory? Are we in a transitory inflation, or can you maybe touch base on that and give us your thoughts?
Well, the first thing I'd like to mention, just kind of dovetailing on what Jason was saying, is Shadow Stats, or the Chapwood Index. And Shadow Stats really measures today's inflation the same way that it was measured in the 1970s. So people say, okay, I get it. So inflation might be a little bit higher today, but I don't think they really give it enough thought, because let's just assume that the CPI is correct today, and people assume the CPI was correct in the 1970s. Those two things cannot be true. You got to pick one or the other, because if you really think that through, if we measured inflation today the same way we measured it in the 1970s, then inflation today would be a lot higher. But if we measured inflation in the 1970s the same way we measure it today, then inflation in the 1970s would have been a lot lower, right? So if you believe that we had significant inflation in the 1970s, then you have to also believe that we have higher inflation today. And if you believe that we do have low inflation today, then you have to believe that the entire decade of the 1970s was fake news, that the inflation was actually a lot lower and people were just imagining it. And, I was very young in the 1970s, but I've talked to Jim Rogers about this extensively as far as, could you see inflation? And he told me, George, absolutely. Every single day you went out, you could see prices rising. So I personally doubt that in the 1970s was a decade of very low inflation, and therefore I believe that the inflation rate, if you measured it the same way today, is significantly higher. Now, I don't know that it's in the 10, 12, 15%, but I definitely think it would have to be in the 5, 6, 7, 8, and especially what we've seen in 2020 and 21, maybe closer to that 10% mark. Now, then going back to the rate of inflation, I think the biggest thing that people kind of get wrong is they see inflation as a monolith. And what I mean by that is it's just this one big block that just goes up or down. So if you have the CPI going up, then all prices are going up. Housing prices are going up. Stock market's going up. And the dollar is most likely going down on the DXY. And I just use that because that's a measurement of the dollar against a basket of other currencies, 57%, which is the euro, right? So people think that this all just happens at once. And if the dollar, if we're having deflation, then that means prices are going down, assets are going down, and then the dollar is actually appreciating in value, going up on the DXY. But if you actually just look at the charts, you see that there's no correlation at all. We can have times when the dollar, or excuse me, CPI, even the way the government measures it now, is going up just at a very steady trend, call it 2 or 3%, while at the same time, the dollar is gaining value against the euro or against another fiat currency, or it's going down. Then we can still see asset prices going up and down and up and down, and that really holds no bearing to what's happening in prices in the real economy, or what's really happening in terms of the dollar versus the euro or the yen or something like that. A good example is the 1970s, going back there, where we had, let's just assume that it wasn't fake news, and we did have a lot of consumer price inflation. From 72 to 74, the stock market went down by 50%. And that's in nominal terms, not in real terms. So the first thing that the average Joe and Jane needs to do is compartmentalize inflation and say compared to what? You know, that's something that Jason always says. When you're saying, okay, well, what is the value of the dollar doing? I can't answer that question. What do you think what do you think the value of the dollar is going to do compared to what? And that is your starting point. Then I think it goes back to what Russ was saying about it's pretty much an equation when you look at the amount of dollars that are circulating, chasing a certain good or service or asset, and with what rate of velocity, right? So there, I think the question really becomes how dollars, or it really boils down to understanding how dollars are created. And this is something that I talked about at the Real Estate Guys Investment Conference there the other day in Belize. And in the past, dollars were created by the commercial banking system. So a constraint there on inflation would have been the bank's ability to find good lending opportunities or good borrowers that would most likely pay them back. And usually they would take those dollars to create productivity, to create more goods and services. But that's going to be a constraint on the commercial banks. You know, they can't just lend to anybody because they have a P&L and they have a balance sheet, right? And if they give out too many loans and they're not being paid back, well, that bank isn't going to be around for very long. So if they're in control of creating more dollars, but what if there's no one to lend to? What if the balance sheets, what if the consumer balance sheet is completely levered up? The corporate balance sheet, all-time highs as far as the debt. You know, at sovereign levels, we have debt at all-time highs. So if you're a bank and you're like, hey, I want to lend, in other words, I want to create more dollars, there's just not that much opportunity. So that brings us to the amount of dollars. And if you look at 2020, the amount of lending, once we got past the PPP loans and whatnot, the amount of lending in the commercial banking system actually went down. It was declining. So if they're in charge of creating dollars, then you've got fewer dollars being created. But for anyone who watches M2 Money Supply, you know that the dollars in the real economy actually went up by 20%, or excuse me, 25%. They increased by 25%. So how does that happen? Because we've moved into this hybrid system where it's not just the commercial banks creating dollars, but it's also the government spending the dollars through all of these stimulus packages. In other words, the deficit spending, where the Fed is creating bank reserves to buy those treasuries from the Treasury from Janet Yellen when she auctions them off, and they're not taking dollars out of the system. So when Janet Yellen spends the money back into the economy on net balance, you see the dollars increasing. So my point is we've moved from a system where it's just about the commercial banks lending. That's how you create more dollars chasing goods and services. That's your equation that you can look at with velocity to try to figure out what inflation is doing. But now you also have to consider the government deficit spending and the degree to which the Fed is monetizing the debt. In other words, buying those treasuries with newly created bank reserves. And then the third thing that I think you've got to look at is a central bank digital currency. Because if we move, and I'll try to keep this short, but if we move to a central bank digital currency, basically the Federal Reserve is taking the place of the commercial banks that in our first example, right? The big difference there is they don't have the constraint of the P&L. They don't really have the constraint of the balance sheet. So they can lend to whomever they want, and they can lend to whatever degree they deem appropriate. And if they're lending that much or that little, that means that they have control over the amount of dollars that are circulating, not only in the financial economy, but in the real economy. Because when you look at the difference between base money and broad money, the base money is just the liabilities of the Fed. Those are the dollars, the cash, if you will, of the majority of the banks under their umbrella. That increasing that base money, really you've got that circulating and chasing assets. So you see the stock market go up, you see the bond market, prices go up, interest rates go down, stuff like that, where it really doesn't circulate in the real economy unless those banks are using that excess balance sheet capacity, those extra bank reserves, to back up more loans. And that's what we talked about in the first place. So I think if you believe the system is going to stay the way it was prior to 2020, then you're most likely going to be a believer that asset prices are going to come down in nominal terms. If you believe we're going to stay in this hybrid system, then I think that you've got to expect consumer price spikes and then kind of plateau and then maybe back down a little like we saw in the 1940s. If you think we're going to a central bank digital currency, then I think you must also believe the probabilities are high that we're not only going to see inflation, but it's not going to be transitory. It's going to be something much more consistent and permanent, something like we saw in the 1970s.
Well, George, you covered a lot there. So if anybody listening maybe wants to delve into that, if you don't follow George Gammon on YouTube, you should, because he has videos specifically about a lot of those things. And I love how you said 3 things, because usually you get up and you say, like, I got 3 things to cover, and you covered a lot of stuff there. That was really good. So talking about supply and demand and disruptions, stimulus and currency being printed at unprecedented levels, and there's kind of everything is changing substantially. Russell, talk to us a little bit about what you mentioned with stagflation, or maybe some of these shortages or things that are happening. How does that affect kind of what we're looking at and what we should be doing?
Yeah, and definitely want to do that. And I think I'm the old man on the crew here, and I definitely remember the 70s. So, George, I will flat tell you it did happen. I collected comic books as a kid, and I watched them go from 10 cents to 12 cents to 15 cents to 20 cents to 25 cents to 35 cents to 45 cents during that period of time. I worked at a gas station.
What do they cost now?
They're like $3.95. It's ridiculous. Yeah. And I watched the same thing happen with bubble gum. I had a business where I would go buy bubble gum in bulk, 2 pieces of bubble gum for a penny. And then I would sell them for, anywhere from 1 to a nickel each at school. And I made money that way. So I paid attention to all that stuff. I pumped gas, and I watched it go from 35 cents, 45, 50, 80, up to $1 a gallon. But I also experienced shortages. But Bronson, I want to kind of help everybody out, because I think that I've been following George, and I feel like I know how his brain operates, because he's a macro freak like I am. And, but I spend a lot of time trying to interpret for Main Street, real estate investors. I mean, the bottom line is this: the system requires the exponential growth of debt, right? And I could explain that, but just take that at face value. That's why no matter what political party there is, no matter what debate goes on about the debt ceiling, the debt will always grow. People think erroneously that we have a sound money system. So they would like to see the government pay the debt off, and they try to pay their own debt off. Well, they can't control the government. So what they do is they work hard to, pay down their consumer debt and kind of Dave Ramsey their life. And that makes sense in a sound money system. But the problem is that because the system requires debt, if people will not go into debt, which is what the bankers would prefer, then the government's going to do it for you. And the government is going to borrow public debt. And then in order to continue to expand debt when there's no borrowers, and I'll go back to my experience in the great financial crisis or in the period leading up to it, I was in the mortgage business. And you go all the way back to Fannie and Freddie when they were created in the 40s or 50s, the GSEs, government-sponsored enterprises. You basically introduced a subsidized competitor into a for-profit system. It wasn't possible for lenders to compete with that because their cost of funds was cheaper. They had implied safety, which became overt safety in 2008. So that pushed the for-profit competitors out to the margin. Same thing in healthcare. When they if they go to a single payer healthcare, or they go to a government option in the healthcare system, it pushes. And we have a doctor who's in our program who quit practicing traditional medicine and went to cosmetic and cash pay type business. It pushed him out of mainstream medicine because he could no longer compete, right? So these are distortions that happen when they start tweaking. And, George talked about the idea that, hey, do you believe that this system, this hybrid system is going to continue? My vote would be, yeah, it has to. And the government is going to continue to print treasuries because those are the tokens, the chips they need in the financial system to lever up. And then they borrow against those. That's the collateral. And they can't find good collateral in the community, meaning real estate, meaning real borrowers, real businesses. They create collateral out of thin air. And we think of it as government debt, but that's not how Wall Street and the financial system thinks of it. They look at those treasuries as pristine collateral, to quote George from the summit, and they have to continue to add those chips so people can continue to borrow against them so they can continue to expand debt. The reason all of that matters on Main Street is because almost everybody watching this, I promise you, thinks, denominates, earns, pays taxes in. Their whole world revolves around the dollar. One of the most important things you can do in an environment like this is learn to think outside the dollar. And that comes back to what you asked me, Bronson, about the concept of nominal growth. And so just imagine this, and I'm going to try to do the math in my head real quick. Imagine that you're a company and you're manufacturing, 1 million widgets a year, and you're selling those widgets for $100. So now you're $100 million company. Because of inflation, your costs go up, your labor costs go up, all that stuff happens. Now you're selling your widgets for $12 each, and you're selling $1 million a year. Now you're or whatever the number is, $120 each, right? So now you're a $120 million a year company. But at $120 million, let's say you needed 10,000 employees to do that. Let's say you needed 1,000 employees. You with me? So you're a $100 million company. You're making 1 million widgets at $100, and you need 1,000 people. Okay, got it? That's your baseline. Now you got inflation, so you're at $120 a widget. You're a $120 million company. You still only need 1,000 people because you're not making any more widgets. But you actually end up having to make less widgets because people can't afford them at $12. So now you're only making 900,000 widgets at 120. So you're a $108 million company if you do the math. So you say, gosh, I grew my company by $8 million, but I laid off 10% of my workforce.
Right.
So I have nominal growth, but I have actual decreased productivity. The world is getting 100,000 less widgets a year. Or 10, they went from making 1 million widgets to 900,000, right? So there's less product in the world, and there's less jobs, and yet the numbers go up. That's nominal confusion. That's nominal growth with real productivity shrinkage. That's what happens when you measure everything in dollars, and that's the only way you think. When you go to an economy that was a manufacturing economy and measured itself by its productivity, and today has become a financialized economy that measures itself by its nominal growth and its consumption,
right?
Right away you've got a weak economy, and it's been papered over, not for a year, not for a decade, but for decades. Yeah. And there are economists, financial planners, business people who don't study enough history to understand where we're at. And then they're going to think, oh, well, this is going to be inflation like the 70s, and they're going to jack up interest rates. But they can't, because there's too much debt in the system for the reasons I just mentioned. And if they were to raise interest rates, all those bond price values crash and they've all been levered up in the system, meaning they've been pledged as collateral. And when you pledge paper asset for collateral against a loan in the financial system, and the collateral value goes down, unlike real estate, you get a margin call.
Mm-hmm.
And that's what happened in 2008. And now everybody's a seller because they need cash. Everything goes no bid. You get a temporary spike in the dollar because everybody needs the dollar.
Right.
But at the end, it's just a Titanic tilting up before it sinks, and everybody runs into the dollar, and then everything is going down. And George talked about the DXY. That's comparing the dollar to other currencies.
Mm-hmm.
But if all currencies jump out of the airplane and they're all in free fall, and one pulls its chute relative to the other ones, it looks like it's going up, but they're all falling.
Yeah, right.
And so you can't think in terms of dollars and play this game if you really want to understand what's going on in the economy. And that is the single hardest challenge, especially for American investors right now, to think in terms of real assets, real productivity, and be prepared, because we may be denominating our wealth and investing in a different currency in the not too near future. And if you haven't already planned to do that, you're probably going to be on the wrong end of the transition, my friend.
Yeah. That was extremely well said. And I just want to add one thing in there where you're saying that it's a system that is dependent on ever increasing amounts of debt. The issuance of new debt, most by the commercial bank system, in other words, is issuance of more dollars. So if it's a system it's predicated upon increasing debt, it's also predicated on increasing amounts of dollars, which is kind of gets us probably to our next topic of discussion, which is how to position your portfolio. And I know Hartman has got some brilliant ideas on what to do if we live in a world where we're always going to get more and more and more and more and more dollars circulating in the system.
So we'll kick it over to Jason here 1 second. I just wanted to say one thing real quick on that. I love the discussion. I remember, George, you mentioned that when we look at wealth, and you're talking about, Russell, outside of the dollar, it's really hard for people to think outside of the dollar. But you mentioned something. You said we need to think about wealth of just being productivity, is having cash flowing assets, or how much does a country produce? And I even look in the background, George, you've got people working at your place right now in the background there, which you're being a very productive individual. So I just want to point that out. Because some people say it's a little distracting, but I'm like, no, it's great. It's being productive, killing two birds with one stone. So, but absolutely, you mentioned, and I think this is really what everybody wants to know is, okay, the printing's happening, it's here, it's going to stay. The government really can't stop, because if they raise interest rates, the whole thing kind of blows up. So how do we position ourselves right now when all this money is out there, and we can, what should we be putting our money in? So Jason Hartman, you give us your thoughts.
Well, just a couple comments before I answer that question. Those were two great segments with Russell and George. I mean, I really enjoyed hearing both of those. And, number one, I agree that I think Russell believes we are moving into a stagflationary environment. And I think that's very, very likely. And that's really when the term the misery index came back in vogue in the late 70s during the Carter era. And that was all about like this scarcity Malthusian thinking. Malthus was this economist who, thought that we were going to run out of everything because of overpopulation. And he's been proven wrong over and over, because he never viewed people as a resource, only as a cost. And sadly, we see a big movement, the environmental leftist movement today, that views people as a cost, not a resource.
Right.
And people, yes, they create problems, but yes, they also solve them. There are many Einsteins that haven't been born yet, and they will be a resource for the world, right? And then also what was said earlier is, people have a really hard time understanding why the game needs to continue the way it is for the government and all governments and all central banks, not just ours, really. And that's the concept that it really was very hard for me to get my head around when I started really diving deep into this stuff about 18 years ago. And that is this. And I still don't know if I really get this, like internally, like in my gut, and that is the idea that money is lent into existence.
Right.
And when I say money, I really shouldn't even say money. I should say currency.
Dollar.
Right?
Currency. Yep.
Yeah. Currency is lent into existence. So it is a debt-based system, and it has to continue that way. It won't work any other way. We're in such a deep hole now that there's just really no way out of it. Well, I don't know. There's an end game, right, George? We could talk about
collapse.
that. But that doesn't look pretty. But, the things we can do today are to, number one, try to think of our lives outside of the dollar, like Russell was saying. And, we've got to ask ourselves, when we look around our world and our lives, what things have intrinsic value that aren't attached to any one currency, and they're not dependent on any currency? Look, if all currencies crash tomorrow morning, I will still need wood, copper wire, oil, petroleum products, the labor of other people. All these things still matter. They have intrinsic value. They're not indexed to any one currency, right? And so those are the things that are really important, the things that have intrinsic value. And if we look at the global financial crisis, or the Great Recession, as I like to call it, 12, 13 years ago, I always say on my podcast, the day before the Great Recession, if you consider that the day Lehman went under, or the day, the mortgage companies started failing, or WAMU, or whatever, Washington Mutual, I don't know, whatever you consider it to be, right? The day before that, if you looked around in the world, there was a certain amount of real estate, a certain amount of oil, a certain amount of gold, a certain amount of silver, right? And the next day, the world had the same amount of all that stuff.
Right.
Yet we were in a collapse, right? But the actual things did not change. The only way they change is they get destroyed through war or natural disaster. Otherwise, they're all still there. And they were all still there the day before and the day after, right? And so we need to denominate our lives in things, not fake fiat currencies. One of my listeners sent me a package of this years ago, and these are Zimbabwe dollars. Okay, and this is a 100 trillion Zimbabwe.
I have one of
dollars.
those.
Okay.
Yeah,
Amazing.
Yeah, and these things are, you can buy them on Amazon or eBay now. They're demonetized, and there's a high likelihood that some of our higher currencies, like the $100 bill, will become demonetized potentially, or just made worthless through inflation. So we need to own and control things. And the best way to own and control those things is with other people's money, not our own, as much as possible. And the best asset for that, I say, is income producing real estate, because it has these really special multidimensional characteristics that other assets don't have. Now, some would say, and I hope I'm wrong about this one, and I certainly own some of it because I don't want to miss out if I'm right or wrong, and that's Bitcoin, right? So cryptocurrencies and things offer alternatives. I'd love to see them succeed. I don't have a ton of faith in them because I think governments and central banks are too powerful. So I just like owning commodities. I want to own things that people want, and I can trade with those regardless of whatever a currency does. And if I can own those with largely borrowed money that is deflating in value through inflation. In other words, if everybody watching thinks of this, if you borrow $1 million today and you borrow that against 10 or 5 houses, okay, say 5 houses, 200,000 each, $1 million in loans, or say it's $1.2 million in real estate, $1 million in loans, and say those loans are interest only. And you're not paying down any principal. As you move through time, those dollars become less valuable, meaning the value of the mortgage becomes less valuable. So you pay it back. You borrow it in today's dollars, but you pay it back in tomorrow's cheaper dollars. And I call that inflation-induced debt destruction. And it's just a beautiful way to game the system, if you will.
Yeah, another way to say that, Jason, is today you're borrowing $1 million worth of purchasing power, and in 10 years or whenever, you're paying it back with $5 of purchasing power,
right?
Or the rate of inflation. If you think of it in terms of purchasing power instead of dollars, I think it makes it easy for people to get their head around as well.
Absolutely. It's not what the dollar is called. That's the name of it, nominal dollars, right? It's still called $20. It was called $20 50 years ago before Nixon took us off the gold standard, right? It's still called $20, but the value of it is substantially lower in real value.
Yeah, that's right. Yeah, one thing I also wanted to just plant a seed in everyone's mind, is I also think there's a high probability that, especially longer term, 5-10 years, we get stagflation. But I was thinking about that the other day, and I don't know that we get the typical stagflation in the sense that we get high unemployment and we get high inflation. I think we actually might have high inflation, but very, very low unemployment, because MMT is becoming so popular. And a good portion of MMT, or their narrative, is a jobs guarantee program. So I think that the net effect will be the same. We'll get poorer because unemployment rates at 1%, because this jobs guarantee, doesn't mean that we have more goods and services being produced. I would argue, in fact, we have fewer goods and services being produced because of the distortions in the economy, because of the jobs that the government is quote unquote producing. So we're going to be, I think, even in a worse place than we would stagflation, but effectively kind of the same thing, but this weird kind of spin on it, where you've got the inflation, but you also have technically low unemployment because of that MMT. But one thing I wanted to say is, we're talking about how to, what strategies to use for your portfolio if we get significant rates of inflation or the stagflation. And this is something that I've really thought a lot about over the last few months. And it's that why do we want our portfolio to go up? Why do we want more purchasing power? And I think what it boils down to is, the more purchasing power you have, it doesn't buy you happiness, but it buys you a hell of a lot of freedom. And so if you're someone that values freedom, that's why you want your portfolio and your purchasing power to increase. But it all goes back to that freedom component. So I think when we're discussing, how to position yourself for the future from a standpoint of your financial future, I think you have to start by positioning yourself for your personal future from the standpoint of liberty and freedom. Because we all saw in 2020 that, the four of us sitting on this panel right now probably had significant resources in terms of dollars, or even of assets, even of commodities, even of real estate. But how much freedom did we have? Zero. The government locked us in a cage and wouldn't let us go outside. So I don't want to get off track there, but I think that that's definitely something that people should consider as far as maximizing or maintaining their level of personal freedom in addition to their financial freedom.
I think it goes a step maybe deeper, in that the essence of wealth is freedom.
Right.
That's the essence of it. If you look at our Constitution, it was designed to create a free people. What was the number one thing? We had freedom of ideas. We could own our ideas, express our ideas. We had the freedom of movement, the ability to assemble, get together. We had one of the most important to wealth building, which is private property rights, to be secure in your possessions, unreasonable searches and seizures, due process, all of those things. Many of those things have been trampled.
The rule of law.
Yeah, and the rule of law, so that, I used to teach this in Sunday school. We'd have 30 kids there, and somebody'd come in with a Game Boy, and I'd say, hey, let's have a vote. The one kid with the Game Boy, we think that he should share that with everybody, even though it belonged to him. And we would vote, and it was 29-1, right? And the 29 all voted that he should share. And then I said, is that fair? Or does he have an unalienable right, regardless of the mob, to his private property?
And so, George, the idea, the majority,
correct. That's, and it frosts me a little bit when people that took their civics in public schools don't know the difference between a constitutional republic and a democracy, or the importance of it. People come into our program to learn how to build wealth, but they don't even understand the nature of wealth, or that the very things they may support in a political sense undermine the very wealth they hope to obtain. It just is amazing to me, but it just shows how far we've gone from really truly understanding what's happening around us. But George's point is well made, because once you have that freedom, the next question is, what do you do with it? I know a lot of wealthy people, and they don't sit around sipping Mai Tais with their toes in the sand in a hammock in Belize, right? I could do that if I wanted to, but I don't. I use my freedom to share and enhance other freedom, to create a free world, a free environment. If we don't take a vested interest in taking our own prosperity, in other words, the oxygen mask drops, right? We're losing freedom, cabin pressure, if you will, in the plane. I've got to become financially free myself first so that I can focus my time, my energy, my efforts, my resources on helping the person next to me become financially free. Because every person in society who values freedom, who values wealth, who understands what the nature of that wealth is and the importance that we band together as individuals and resist the tyranny, the globalists, the centralists that want to control our healthcare, our money, our food, our activity, what we put in our body, what we can do with our body, what we can do in the privacy of our own home, what we can say, if we can move, all of that, right? If we don't work to preserve that for each other, we lose it for ourselves. So Jim Rohn would call it our enlightened self-interest, but really that's the essence. The purpose of financial freedom is not self-indulgent. That's easy. That's very low level. Prosperity. True prosperity is building a richer world, a more abundant world, and having counterparties to trade with. I like hanging out with wealthy people that are rich in ideas, that are rich in values, that are rich in financial resources. We can trade, we can do projects together. If I was the only rich guy in the world, then it would be a sad world. There wouldn't be anybody to trade with. And of course, I would always be in danger that the mob would come and take what's mine. There's plenty in this world. To Jason's earlier point, communism is where the government supports the people. And that makes the people a dependent, a liability. Capitalism is where the people are free, and they not only support themselves, they create abundance, and the purpose of government is to protect that freedom so they have the ability to create the abundance, and people are an asset. And we have the ability to use our technology to make arguably limited resources go further, do more, and ultimately maybe not even be necessary. Who knows what technology, to Jason's point, how many geniuses are yet to be born that maybe weren't born in China under a one-child policy or a two-child policy. I mean, who knows? So that there are fundamental philosophies out there about the way the world works, about what is value, and it starts with human beings. If you don't value human beings, then you're not going to create a society that allows anybody to be prosperous, because you're just part of the herd that needs to be culled in order to preserve special resources for some group of people who think they deserve the resources more than you do. So we're at a point in history where those powers have consolidated and they're making moves. The good news is, I think people all over are banding together and realizing that something's wrong. They maybe don't completely understand what it is, but the very things we're talking about is how to use the system they've created to enslave us to actually set ourselves free. And that's the magic about what Jason talked about. If you understand that we live in a system that requires debt, and then you can master the art of becoming wealthy by using debt, well, now you can use the very weakness of the system to become strong. And that's a major fundamental part of what real estate investing is all about. Debt lets you short the dollar. And then you combine that with other real assets like agriculture, energy, precious metals. Now you really have a formula where you can nominally outpace inflation. Whatever inflation is, you should be able to double, triple, quadruple it and outgrow whatever rate it is. You just have to own the right things the right way. And that's really what this is all about.
Yeah.
So Russ, you really dropped some nuggets. I just want to pause real quick.
Very well said. Yeah. Very well said.
Yeah, just the idea of the essence of wealth is freedom. And it's hard not to talk about this stuff and have it get a little political, because when it comes to property rights and the idea of even what we learned a bit about collectivism versus really supporting individual rights, like the guy with the Game Boy, I mean, that's a great example. So George, I want to hear a little bit from you. We're going to open up for questions in a minute here, and we're just going to kind of roundtable it. But can you talk real quick about the 80-10-10 strategy that you mentioned? I just thought that was a very practical thing that people, when it comes to allocation, I've talked to, over 1,000 investors. Everybody's like, how do I allocate? How do I put money in deals? Or how do I put this here? Can you maybe talk just based on the 80-10-10?
Yeah. Before I do, though, I really want to say a couple things there on what Russ was saying, which was very, very well said. I just want to point out that whenever I do my videos, I always try to shy away from using the word capitalism by itself, because it's not just capitalism. That doesn't solve the problem. Free market capitalism is what solves the problem. We have to have free markets. And when we're talking about the amount of dollars being printed and what happens when the, Jerome Powell and the money printer go burr, we've all seen that meme, right, over and over and over again. But I want to point out that it's how the Bitcoiners always say Bitcoin solves that or Bitcoin fixes it, but free market capitalism fixes that. And I'll tell you why. Because even if we have a large amount of dollars being created, the solution for consumer price inflation is just to have the amount of goods and services in the real economy increasing at a greater pace than the amount of dollars. You see, it's not the amount of dollars that's being created that's the problem. It's the lack of stuff that's being created. And that goes back to the government restrictions, the controls, the regulations, the high taxes. And that's why I always try to use the term free market capitalism when I'm talking about solutions instead of just the term capitalism. But going back to the 10-80-10, so that's the way I set up my own portfolio. And I do it because I'm an amateur and I'm not that smart of a guy. I like to keep it simple. And the way I look at things, if I just have 10% of my portfolio, and this is aside from your cash position, I want to make that clear, because for everyone, I think their cash position is dependent upon a lot of different variables. But the amount that you have invested, let's say, 10% of that is, for me, insurance. And what I consider insurance is physical gold. And it's not silver. I know a lot of people would debate that, but I just think it's physical gold. Why? Because it's maintained its purchasing power over 5,000 years. And if I had to bet, I would say that it's going to maintain its purchasing power for another 5,000 years. So that's kind of my insurance policy. Also, too, I want to point out that you don't have to have inflation for gold to go up in purchasing power. You could have deflation, and the gold just goes down in value less than all the other stuff that you're trying to buy. And it could be temporary. I won't get into the liquidity issue, but when you have a big stock market crash, a lot of times you'll see gold go down with it, but that's only temporary because people need that liquidity. The only thing they have that other people want to buy is the gold, and so they get rid of it. Anyway, so then the next portion would be the 80%. And how I would define that is an investment. So something that pays you to own it. That's how I define investments. And that goes right back to something that Jason has been saying, and he says it so well, that when you buy an investment, it should work from day one. From day one. So if you're buying a cash flowing rental property, or if you're buying a very cheap dividend paying stock, like back in 2020 March, I just loaded up on a lot of oil producers, and I was buying them at rates where you're getting an 8, 9, 10% dividend, and some even some overseas. So that's something that pays you to own it. But you see, the magic there is not only are you getting paid, so you're never a forced seller, you're never a motivated seller, but it also doesn't have to do anything. Like if I buy Tesla today, and I don't know what it's trading at, but let's just say it's trading at $600 a share or something. And I think that my price target is 2,000. Well, in order for me to quote unquote win on that investment, something has to happen, right? It has to go up in value. You have to have a capital gain. But with a rental property, assuming that you do it right, or a good dividend paying stock, nothing has to happen other than what has happened over the past 10 years. It just has to continue to happen. So if the price goes up or down, what do you care? That's not why you're buying the asset in the first place. So that's why I like to have a majority of my portfolio in investments. In other words, things that pay you to own them. And another reason is because you can leverage that 30-year fixed rate debt that the guys were talking about earlier. But then I also like to have 10% of the portfolio allocated to what I would call speculations. And it's not using that in a negative term. It's just simply something that you see as cheap, and you see that you think that there's good asymmetry, but it might not pay you to own it, such as maybe a junior gold miner, maybe Bitcoin, or maybe back in 2020 I loaded up on uranium. So that was an example of something that I saw as a speculation. I thought it was cheap, and I thought there was good asymmetry. So that's how I like to kind of break up my or break down my portfolio.
George
Thanks,
keeps
George.
the uranium in his closet, by the way, just so you know.
I wonder where he keeps the plutonium. I'm thinking of Back to the Future, where they have to
in the kitchen.
Yeah.
That's pretty funny. That was great answer. Thank you, George, for that. I'm going to toss this one to Jason, and if you guys have questions, go ahead and drop them in the chat box. We're going to take a few questions here. So this is from Susan. It says we are Canadians who own 7 single-family homes in Oklahoma City, mortgage-free. Would you recommend holding part or moving these investments to a different part of the country, considering the Great Reset agenda? So it's interesting they own them mortgage-free. Jason, do you want to kind of comment on maybe just some thoughts on that situation?
Yeah, Oklahoma City is a good market. We've done some business there, not that much. It is a little bit dependent on oil market, so it's more influenced by that than some other markets. But the concern I have is twofold. Number one, make sure you're diversified into at least 3 markets, not more than 5. One of the mistakes I made is being over diversified. That was a mistake I've been trying to unwind for a long time. So 3 markets at least, not more than 5. And but get those properties mortgaged. Now, as a Canadian, it is harder, and Russell will tell you this, of course, too. Foreign nationals don't get to take advantage of all the great government welfare loans we get through Fannie Mae and Freddie Mac like Americans do. So Americans take advantage of this welfare program for real estate investors. It's pretty awesome. You want to take advantage of that, but you can still get some leverage on those properties. And don't as Russell says, don't Dave Ramsey your life, because Dave Ramsey is good in the market he talks to. His base is people that have stupid credit card debt. They, waste their money on the appearances of wealth rather than things that build real wealth. That's great. But once you're to the point of being financially responsible, stop listening to Dave, because it's over. His game is over after that. He doesn't know how to invest. His advice is terrible about winning the game, but about getting out of debt and not losing. Yeah, he's got good advice there. So get some mortgages on those properties and use that money to potentially buy more properties. You want to get that inflation-induced debt destruction, and if you have them paid off, you don't get that. And it's counterintuitive, but the more equity you have in the property, the more at risk you are. For example, nobody ever owns a property free and clear. All of us have a perpetual lien on our properties called property taxes, and maybe we have a homeowners association too. And when you have a large amount of equity in your property, you actually become a target. There are all kinds of, I see Russell and George nodding their heads right now, right? Because they know this. There are all kinds of investors or vultures out there who prey on properties with large amounts of equity. You want to strip the equity out of your properties. Real estate is a great investment, but it's not a great bank. Okay, so get the money out, get control of that equity, and use it productively to do the things that George just mentioned and we're all talking about here.
Yeah,
we use real estate to create equity, but that's not where we store it. I debuted at the summit a whole strategy for converting real estate equity into gold. Because if you're going to store equity on your balance sheet, you're not ready to buy more property for whatever reason. Gold is a great place to store that equity, because if you do have a currency collapse, it's like home base. You can pivot into any currency, and you'll have purchasing power from that regard and a fair amount of liquidity. And depending on how you choose to hold it, you can mitigate some of the tax and the friction of the transaction. So, we don't have to get into that now, but I agree 10,000% that leaving equity in real estate once it's there does many bad things and not very many good things. So just on a risk versus reward.
I think it's super important to point out.
Refi till you die.
Yeah, but I think it's super important to point out, though, as long as you got positive cash flow after you do that refi, you never ever want to say, "Oh, well, Jason told me to take out a 30-year fixed rate mortgage on my house, so I'm going to do it." But then you got a negative carry, right? Even if you got a renter in there, you don't want a negative carry.
Let me just quickly address that, because financial strategy is kind of my wheelhouse, and it's really, really simple. It's a concept called arbitrage. We all know what it means. Basically, you're trading in a similar instrument and making money on the spread. So if you take out a 30-year fixed mortgage, say at 4%, and you pull a bunch of equity out, call it 200 grand, and you take 100,000 of it and you buy a first position note on a property that you wouldn't mind owning with 20 or 30 or 40% protective equity, meaning they've made a down payment, and you're earning 8%, and that paper is out there. Those investments are out there. Now you have 100% of the income you need from half the cash out proceeds to cover the note. Now you're cash flow neutral, and you have $100,000 of cash out proceeds with no payment attached to it. It's not taxable because it's cash out proceeds. You could purchase some gold with it. You could purchase some Bitcoin with it. You could use it to make a down payment on another property and not have to use the cash flow from the new property to float that. I'm a big believer in using private notes as a way, or note pools, high yielding, backed by great collateral, as a way to arbitrage the cheap debt, because the money is so cheap and yet those income opportunities are out there. I can show you how you can refinance property, like a property that you're making a payment on, like you live in, and you're making the payment out of your house payment. And as the property appreciates, you keep refinancing it and investing those proceeds in high yield debt. And pretty soon your equity is paying off your own mortgage and you have no house payment. Right. So there's a lot of things you can do once you understand that basic concept of arbitrage. Borrow low and invest high, and you don't have the landlord, you don't have the capital risk. The only risk you have is default, right? If they default, but if they default, it's not like a bond where if they default, you're screwed. If they default, you're going to take back the property. You can sell the property. You're going to get it at a discount because they had a down payment. You could rent the property. You could sell the property on an owner carryback and originate a new note with a new down payment. And then when you do the real yield on that, it's really, really high. Or you could rent it out. I mean, you could do and take the tax break. So you have lots of exit strategies when you're on the note side. A lot of real estate investors only look at being on the equity, the ownership side, and they don't look on being on the lending side. But there's big opportunities in that.
Yeah, so we're getting a lot of questions here. We're just going to kind of go through some of this. And again, we're not going to get through all of this. And there's a lot of things here that I know for some of you, this is a bit advanced, but everybody here has YouTube channels that you can go to, or you can search these terms and go and look at it. Also, we have decided to send this out as a replay. So some of you may have been wondering that we are going to send it out as well. We are having an event next month. It's the 28th. I'm just going to put it in the chat box. It's going to be talking.
Oh, what?
Did you mute yourself there?
Yeah. Brunson, I think you just muted. We just lost your audio, buddy.
I think I did. I think I hit the wrong button there. So there we go. Okay, I'm back.
10 seconds.
In the last 10 seconds. So we're having an event next month on the 28th. I
don't hear Bronson.
You can't hear me?
I hear you.
You hear me? Okay. We're having an event basically about investing in precious metals and some of this precious equity strategy with Russell and a couple other awesome guys. So the link is in the chat there. But let's talk real quick, getting into people asking questions about, should I own gold and ETFs, or should I buy REITs or other things? Can somebody here talk about counterparty risk and just do a quick summary of counterparty risk and why physical, George, you said physical gold, like why not equivalents? Like what is the reason you actually should own physical?
Well, I'll punt on the REITs to Jason and Russ, but as far as the gold, let's look at the GLD. That's probably the most famous way to play paper gold, let's say. What happens is you got to look at the custodian. The way these things work is you give $1 to the fund, and then they go out and let's say they buy gold with it and they store it at a specific bank. And then what they do is they hire what they call a custodian to really manage that process and to be in charge of the gold and the auditing and all these things. And so if you buy the GLD, first of all, it's not redeemable unless you own a very large amount of it. But you can't just say, okay, I've got $100,000 worth of GLD. Now I want my $100,000 worth of gold. It doesn't work that way. Also, you've got to look at the custodian for the gold that the GLD holds. And the custodian is HSBC Bank. So I don't know if many of your listeners or followers know the history of HSBC and like Deutsche Bank, but they haven't been the most let's say, sturdy balance sheets. They've done some things in the past that are quite nefarious. So I would not want my counterparty risk to be HSBC when I'm buying something exclusively for insurance. Now, I understand that most people, or a lot of people, can't carry around with them all of their physical gold, although I think that would be ideal. But then I would look at a fund or a gold trust, such as my good friend Rick Rule's trust. It's Sprott, and I believe the ticker is PHYS, I think?
Yeah, Fizz,
and,
PHYS for gold, and PSLV for silver.
Right. So number one reason is because I know Rick and I trust him. I've got an immense amount of trust and respect for Rick Rule, although he's retired. But that's the type of fund where, okay, who's your custodian? The custodian there is just the Canadian Mint. So I would much rather have that counterparty and Rick Rule as a counterparty than HSBC, right? And also that's a fund where you can actually redeem what you have as far as your paper for physical gold on delivery. So if you got to do the paper, I'd far prefer it in that form. But ideally, I would just I'd want the physical delivered to my house and bury it in my backyard as much as you're comfortable of holding.
So you might get some people in your backyard here, George. You never know.
Well, right now I'm in a high-rise condo, so good luck with that. You're not going to be able to find it.
I'll be able to find it. Awesome. Well, guys, this has been amazing. We're kind of getting a little short on time. I feel like we could just talk for hours on this. And again, if you're listening or watching and you just want to learn more on this, each of these individuals here, again, I just have a tremendous amount of respect for each of them for what they add to this conversation. It really is, we're all kind of in this together. George kind of said, hey, I'm an amateur trying to figure out this. George, if you're an amateur, I don't know what I am. So I appreciate what you've brought, Jason, Russell. Let's just, maybe each of you can go over just any closing comments and then how people can connect with you, or if you have any event or something you want to invite people to. And we'll start with Russell.
Yeah, there's obviously a lot to learn, and I would encourage you to attend as many of these and in as many places as you can, and get around smart people. We just came from 8-9 days, whatever it was, with a bunch of really smart people. I'll say, just based on the nature of what we were just talking about, Dana Samuelson, who is a gold dealer friend of mine, was on the Summit at Sea. He and I did a 15-part video series on YouTube about precious metals. And so if you're interested in really understanding that, I think it's pretty good. And we focused on silver, but you can get access to that by sending an email to silverseries@realestateguysradio.com, silverseries@realestateguysradio.com. That'll put you on our list. We'll send you our newsletter. We'll let you know we put out a new podcast, but it'll also send you the information to watch that series. And then when we release the precious equity series, which we're going to be talking about in July, you'll get information on that as well. So I think that's probably a good thing for this group to follow up with.
I just dropped that in the chat there, silverseries@realestateguysradio.com. So you can check that out. Let's go to Jason. Any closing comments on how people can connect with you and next steps there?
Yeah, first of all, I just wanted to say thank you, Bronson, for hosting, and thanks to our panel. It's always great to talk with Russell and George, and I just love brainstorming about this stuff. It's a lot of fun. We are in pretty historic times, I think. So I think it's a time when you better be paying attention. This is definitely not the era, and it hasn't been so in decades, where you can depend on the government except to devalue the currency you own and devalue your savings and your stocks and your bonds and your everything. So be really careful and be really aware, politically aware of what's going on in the world, and do things that ensure your freedom, both financially and otherwise. Have good logical amount of simply prepping and preparedness, not crazy overboard stuff, just a rational amount of stuff that you can do for $300 to $500. It's not a big deal. If everybody did that, the world would be a much more responsible, better place. I'm, of course, on YouTube, Jason Hartman, and I have a podcast called The Creating Wealth Show. And I have a free mini book for anybody watching or attending this at pandemicinvesting.com. That's pandemicinvesting.com. what we did last year is we adopted some of the strategies I've been teaching a long time for the pandemic, because they're a little bit different and they changed with that. So that's at pandemicinvesting.com. And I guess the last thing I want to say is, when I spoke at George hosted a fantastic event just about a week and a half ago called Rebel Capitalist Live, and I was honored to speak there. And I talked about this new index that I've created, which is based on my compared to what idea, and it's called the HCI, the Hartman Comparison Index. And what it does, and I hope it'll be widely recognized and adopted over time, is it compares the value of real estate with the value of a whole bunch of other commodities. And I think this is really the way we have to look at things, is we have to compare them to other things that we need and use in our lives. And so you'll see more of that and learn more about that on my podcast and YouTube channel. And if you get the pandemicinvesting.com book, you'll be on our list. So we look forward to learning with all of you and assisting everybody in their journey. And thanks again for having me.
Absolutely great to have you, Jason. Thanks for joining. George, let's bring it home here. Let's talk about how people can connect with you. Any sort of thoughts you have on our conversation here and what people should do.
Well, I think it's a fantastic conversation, and the three of you are really incredible. My hat's off to you for spreading the message of truth and free market capitalism, and that's the way that we're going to get off the road to serfdom, which I think we're on right now. Where if the four of us and others like us don't put forth an extreme effort, it's going to take us right to totalitarianism, like Hayek pointed out. But I am an optimist, and I believe that we can get off as long as we stick together and really just spread the message of free market capitalism, like I said earlier. As far as what I'd like to plug, I'm going to go a little different direction and plug something that's not even my own product, because I believe in it so much, and I think that everyone should take time out of their schedule to check it out. And this is from a good buddy of mine named Chris Cole. And Chris Cole runs a fund called Artemis Capital and Artemis Capital Management. And he is a specialist in something that's called long volatility. So he wrote a paper called The Allegory of the Hawk and Serpent, where he goes over something called his dragon portfolio, which is a way to set up a 100-year portfolio. He said, if you're going to set up a portfolio today and not touch it for 100 years, what would you want in that portfolio? So he went back and he did back testing, like 97 years or so, with all of these different types of strategies, like buy the dip, as an example. You hear that all the time. Or this 60-40 stock bond split, or risk parity when you're using a little bit of leverage, which is what most people would hear when they go down to their financial planner. They'd say, oh, just do this 60-40 stock bond split just based on your age. And they just show you charts going back to 1981 where conveniently interest rates have gone down the whole time. And they say, well, this is what you should do. But what he actually shows, that if you would have invested in these popular strategies that are talked about a lot, and they're talked about in by Dave Ramsey as an example, and he kind of promotes them, if you will. But if you would have done this back in the 1920s to like say 1920 to 1940, 1940 to 1960, 1960 to 1980, he picks out these time frames. In most of the very popular strategies today that you would get from a financial planner, you would have gone bust 3 times. 3 times. So my point is, it's only in the last 40 years that we've had this down cycle in interest rates that those popular strategies have worked. And I think that probably the majority of the people that are listening to this right now would fall into that category through their 401k or their IRA. And this is the type of investing they do, thinking that this is the safe way to go about it. But I would encourage you to go to Chris's website and check out the Allegory of the Hawk and Serpent and look at that back testing. Because once you do, you will realize how much risk you're actually taking by doing what all your friends are doing and what all the financial planners are trying to push you towards. And so that I'd start there. And once you get done with that, then you can go ahead and check out my YouTube channel. It's just George Gammon, just my name.
Awesome, guys. And I wanted to mention one thing too. Jason, George, and Ken McElroy have an awesome mastermind they're doing, an in-person mastermind that just sounds amazing. It's brand new. So if you want to spend time in person with those guys and just do some really fun, amazing stuff and learn from them, there's a way you can do it. It's called The Collective. Yes, I love it. I saw those t-shirts in Belize. So
I should be wearing the shirt.
Yeah, exactly. And if you haven't heard about the real estate guys, all of their events are amazing. I'm planning to go to Belize next year just because of the quality of the conversations, the events as well. So I want to thank each of you for taking the time to join this event. We're really committed to your own education, and obviously you are as well, because you stuck around to the end. So thank you for joining us. If you go to bronsonequity.com, I've got a free ebook that just talks about the single best investing strategy during or after a pandemic, talking about multifamily investing, both as an inflation hedge, tax benefits, different things like that. So you can check that out. I also mentioned we are having an event next month. I'll drop it in the chat here as well about an inflation hedge when it comes to precious metals, which came up quite a bit today. And that's going to be on the 28th, which is a Wednesday as well. So you can check out that event. But just want to say thank you to each of our panelists. Thanks for taking the time. Thanks for each of you for joining, and to our audience as well. So we'll look forward to seeing you guys on the next event.
Yeah.
Thanks, everyone.
Thanks, everybody.
Thanks, guys.